some value investors are quite skeptical of mechanical models and quantitative approaches, trying to rely more on their judgment and just an understanding of businesses. I'm curious to understand from your perspective, where do you think value investors could benefit from some of your thinking in terms of being a bit more consistent in how they measure things, how they use quantitative analysis?
Yes. I think that value investors represent really the core of the market, because they are the ones who stabilize the market and ensure that there is something called value based on fundamental analysis. So in that instance, it is the value investors who are truly making the markets and bringing real money into the market with high conviction positions for the fundamental reasons that they have uncovered when it comes to valuation. Quant trading or tactical trading is more the short-term market making or short-term trading, which provides liquidity in the market and can grab shorter-term inefficiencies in price movement, regardless if they are value-based or not. For instance, you can buy a value stock, and if it goes a bit higher, you can sell it, hoping to buy it back again. It goes back that we're trying to use time also to our benefit, where given a certain amount of time, we want to turn over the portfolio more often compared to buying value and waiting a year or two or three for it to go higher. So value investors may want to combine or include in their portfolio a shorter term, higher turnover trading process, even on their own value stocks, so they can make money from their existing positions if they have maybe this mean reversion process, or if they have a directional model. So there are definitely, a value investor can come up with their basket of stocks where they know exactly at what price they'll be buyers, at what price they are sellers within a month or two, knowing they'll be holding to this position for years. Because any equity inevitably is going to go through short-term overbought or short-term oversold conditions, and if one is disciplined enough and has algorithmic models in place, they may very well want to seize these opportunities.
Notable value investors, including Joel Greenblatt, have tried to come up with a more quantitative approach, and there is a thing called the magic formula, which has identified two factors, two variables to look for to construct portfolios that outperform. And have you looked at some of these? What's your view on
Sure.
For example, the magic formula?
Sure. I am not an expert in this formula, but what I know is that very, very few people perhaps have been able to successfully combine a fundamental approach with a tactical approach. It's a bit easier said than done, I admit that, because it requires such a shift in mentality to be both a good fundamental investor as well as a good tactical trader. Because a fundamental investor is looking at the market based on strict metrics and relative value of different whatever they happen to be. A trader is more looking at the market as a tactical game, as a short-term balance of power between buyers and sellers, and very few are truly able to have both angles into this game, unless they have multiple personalities or they are schizophrenic almost.